Hey CEOs and franchise owners, I'm Erica Jones, your Profit First CFO. Let's cut through the noise. The One Big Beautiful Bill Act just passed, and while the headlines are flashy, most people are going to miss what actually matters. This isn't just another tax update. This is a direct line to more cash in your pocket, if you know how to use it. Over the next few weeks, I'm breaking down exactly what this law means for your profit, your cash flow, and your ability to grow. If you're a small business owner, a franchisee, or a CEO trying to figure it out, trying to figure out if you're even going to keep what you earn this year, this is for you. Now, today is part 1 of my profit series. So let's dive into the real story behind this new law. The One Big Beautiful Bill Act is the largest tax package we've seen since 2017. So what's in it for you? Permanent profit tax cuts, immediate cash flow boosters, cost savings employer credits, and spoiler alert, it's a 5-year window to cash in before some of these benefits expire. It's a 5-year window to cash in before some of these benefits expire. The big shift, the 20% qualified business income deduction is now permanent. That means if you're an S-Corp, LLC, or partnership, you can now deduct 20% of your qualified profit every year indefinitely. For those of you running multi-location franchises, this is a game changer. If your net profit is $500K, roughly $100K is now tax-free. What you do with that extra profit will determine if you're going to build real wealth or just burn it in new expenses. As a Profit First CFO, I say this all the time. Don't let tax savings disappear into lifestyle creep. Assign that money to your profit account. The bill also raises the SALT deduction cap to $40,000 through 2029. So if you're in a high tax state like California, New York, or New Jersey, you just got a big break. You can now deduct up to $40,000 in state and local taxes on your federal return. But here's where CEOs will miss the opportunity. The pass-through entity tax workaround is still wide open. If you're using an S-Corp or partnership to pay your state taxes at the entity level, you're still winning. So how do you translate this? You keep the money. You keep more money. You get to stack tax savings that weren't guaranteed a year ago. But these savings only hit your bottom line if you control them. Without a system like Profit First in place, tax savings will get eaten by fees, inefficiencies, and shiny object spending. Now let's talk strategy. Profit First isn't just about paying yourself first. It's about giving every dollar a job, especially tax dollars you didn't expect to keep. So if this law is going to drop $20,000, $50,000, or $100,000 in tax savings into your business, you need a plan. Allocate it, protect it, invest it with intention. Use it to build cash reserves, fund upgrades, or pay down debt, not to bloat your expenses. This is where most CEOs miss it. They save on taxes, but they lose in the back end. The win is in what you keep. Guess what? This is just part 1 of the Profit series. In the next week's video, I'm diving into the cash flow boosters hidden in this law. How to write off your equipment and tech 100% immediately. And why this is a once-in-a-decade cash opportunity. Go ahead and subscribe to my YouTube channel or turn on your notifications on LinkedIn. My YouTube is She Knows Profit. Subscribe so you don't miss it. Drop your questions in the comments. I read everyone. And if you're serious about putting this profit strategy to work in your business right now, click the link below in my comments to book your franchise profitability audit or your My Money Story clarity call. I'm Erica Jones. Remember, it's not about what you earn. It's about what you keep. Let's keep more. See you next week.